Hey investors, I just wanted to get this quick video out. It's been a while since I've done a portfolio update. Actually, it's been a long time since I've ever done a portfolio update. The time right now is actually 8:45 p.m. So that's why it's or 8:43 p.m. So that's why it's really dark. So I apologize for that. But I was driving home and I wanted to get this video done because I was thinking about a couple things on my way back. So basically, this video is going to be kind of just some lessons that I learned over these last couple of years investing in a bear market. And if you guys don't know what a bear market is versus a bull market, it's when, basically investors are pessimistic, right, about something. And usually the stock market will take a nosedive and it'll stay down, it'll trade flat for a little while. That's a bear market. Whereas a bull market is, you're just going up. So in this video, like I said, I just want to give you guys kind of my thoughts on everything. And we're going to take a look at the portfolio right now. So without further ado, let's dive into it. All right, so this is the income portfolio. So I have, just two pies. It's hosted here on M1 Finance. I specifically want to talk about my equity REITs. If you guys have been following me for a long time, you know that I've been in the red with this portfolio for a very long time. And throughout that entire time, I've been buying as much as I can. And if we look at my activity, I just got a ton of dividends and I just reinvested those dividends because now M1 Finance offers that. So I was very happy, very pleased that M1 Finance finally implemented that feature. I just love the platform. I mean, they're solid. So yeah, you guys can see all these buys. I mean, I've just been buying like as much as I can, just putting as much cash as I can. And this probably goes for a long time. I mean, yeah, April, in 2024. Let's see date range, if I can change this real fast. I don't want to waste too much time on this because I want to get to the points that I'm trying to make here. It's about investing, right? And being a long-term investor, because that's what's actually the most important thing here. Sticking to one strategy and just like going with it. Letting the thesis play out is what it's called. Letting your long-term thesis on your investment portfolio play out. All right, so yeah, I mean, let's take a look. Again, dividends, let's take a look if we do activity type. Let's do deposits. Yeah, I think that's it, right? Yeah. So yeah, again, these were some of the, because I sold my real estate and then I moved the real estate money proceeds into this portfolio. So again, I was just putting as much money as I can. Every time I got paid, again, just putting money into the portfolio and then just buying as many REITs as I could. So anyways, back to the lessons, guys. Back to the lessons, because that's what is important here. So over the last 3 years, REITs have been out of favor. Analysts, pundits, Joe Schmo on Facebook, everyone was talking trash about real estate. They were saying that, there's a huge collapse coming around. And I'm probably not going to edit this video to include all those articles that I've seen, but there's hundreds of them. You couldn't turn on the TV or open a YouTube video without hearing about this pending real estate collapse, right? Especially from residential and the commercial sector. And this is one of the biggest problems that I have with YouTube, finfluencers and all that other crap, is that they feed off, they're just like the news. They feed off fear and greed and all that other kind of crap. They feed off of that. They need that to keep the viewers. And I get it. I mean, it's a business. You need to keep viewers. That's the new currency. I got that. But if you're an investor, if you're a new investor, or if you're starting out, or if you have started out and you've been investing for a little while, I just want to give you guys some of my own lessons that I've learned over these last couple of years while investing. Now, this is a vanity metric. It's nice to be finally in the green after 3 years, after 3 freaking years. It's finally nice to be in the green. It's nice to see that a lot of my holdings are finally starting to turn green. Cell towers has probably been my biggest ones, my biggest losers. for no reason. They're both great companies. You know, I don't know why they were going in the dumps, but you know, interest rates and all that other stuff. But these are two solid companies. So one of the biggest lessons that I learned is to stay focused, right? And I know that sounds so cliche, but I really mean it. You got to stay focused when you're investing. When you have a strategy, you've back tested the strategy, you've read, you know, probably studies on the strategy, right? You believe in the companies you picked or the ETFs or the whatever, right? You've done the research. You believe this is the best strategy for you. You need to stick with it. I stuck with this through the entire bear market, through all the doom and gloom news, through all the interest rate hikes, through all the, you know, people on Seek and Alpha just saying how crappy REITs are and how terrible that is as an investment. You can go on any finance Facebook group, and if you go back a year or 2 years, everybody was saying how crappy REITs are and you could get a better yield, you know, a better dividend income from bonds or from a money market account. Why would I buy REITs when I could just put my money in a money market account and just collect 5% interest risk-free? Sure, yes, but you're not counting purchasing shares at a discounted price, which has, you know, 20 to 30%, you know, upside potential and even more. I've done enough research on real estate investment trusts to know that after every recession, after every massive dip that's ever happened, REITs have always recovered, sometimes 2 or 3-fold, right? That's 200 or 300%. Not all REITs are created equal, all right? Let's get that straight. And I'm not talking about V&Q. I'm not talking about the REIT index. I'm talking about specific REITs, all right? REITs with, you know, good fortress balance sheets. Leverage, you know, debt is not terrible. It's probably in the low 30s, 30 percentile. You know, they got an excellent management team with decades of experience. You know, they have raising dividends, a history, a track record of raising dividends or never cutting their dividends. And not only that, the sector that they're in is not speculative. You know, like there's office REITs right now. I wouldn't touch office REITs with a 10-foot pole. People are buying it. People were piling into one REIT called Medical Property Trust because of the yield, and then the REIT just went to basically hell, and you know, dividend cuts and price basically got destroyed, and a lot of investors lost a lot of money on that. But yes, through it all, I ignored a lot of the news. I ignored all of the news because I knew the research that I did was the correct research, and it was research based off actual fact. All right. I would probably spend a lot of my time on REIT.com, which is, they're owned by NAREIT. I think it's the North American Real Estate Investment Trust Association, or the National Association of Real Estate Investment Trusts, one of those. But I spent a lot of my time reading their research, their articles, their industry news, and they all were saying the same thing. Over the last couple of years, REITs have been ready for this particular scenario. Ever since the GFC, the Great Financial Crisis of 2008, 2009, these companies have been keeping a massive cash pile. They've been, you know, very responsible with debt, and they were prepared. You know, COVID was a curveball, and then the interest rates rising was an even bigger curveball. But these REITs were very responsible with the debt they were taking. They were not taking on excessive debt that was maturing within a year or two. They were taking on debt that was maturing within 5 to 7 years. You know, that was one of their secrets, or one of their things that they did that was so successful, was taking on debt that was long term, and it was not variable rate. You know, or if it was a very small amount. A lot of it was fixed rate. So meaning that, you know, if you purchased a loan for, you know, $100 million, it's going to be at a 4% interest rate for the next 5 to 7 years, right? Versus some operators that were taking on debt that was like changing with the interest rate. So as the interest rates were rising, so was the interest rate on this loan. And now basically a lot of, you know, some REITs and even real estate investors basically shot themselves in the foot taking out that debt. So yes, I know that was a lot, but lesson number one was I ignored a lot of the doom and gloom news. I stuck to the strategy that I knew I believed in and I researched and I had all my money riding on it, right? I know this portfolio is gonna do very well over these next couple of years. Why? Because as the interest rates come down, these REITs, people are gonna start piling more money back into real estate. And through the last 2 or 3 years, I've already been investing in real estate. It didn't matter, if interest rates were high. There's deals to be made. You could still find good deals. You could partner up with people and find good deals, right? Instead of paying, probably, conventional loan, full cash, whatever it was for a particular property, there's a lot of sellers offering seller financing now. So now all these property owners, they want to get out of their properties and move the cash somewhere else. So they're gonna work with you because they know interest rates are high and it's getting more costly to take on a loan. So they're gonna work with you. They're gonna do seller financing. It made deals so much more attractive. So again, you gotta ignore the doom and gloom news. You can't believe everything you see. You can't believe everything you hear, especially when it comes to media, right? Whenever it comes to media. All right, enough of that. All right, the second lesson that I really learned over these last 3 years is being consistent. All right, I wrote about this in the community, but being consistent. All right, this right here, this right here, this is all consistency. This is setting a schedule. Every time I got paid, every 2 weeks, I'd make sure that I invested some type of money. I don't care if it was $100, 200, 1,000, 400 something dollars. I didn't care what it was. I knew that I had to put money in this portfolio. That was first and foremost, right? Sometimes my bills, were a little more higher than what I could invest, but that is just what it is. But I made sure to at least do my best to consistently invest over time. And that is what this led to. You're going to be buying ETFs, index funds, ETFs, thematic ETFs, sector ETFs, specific ETFs, dividend income ETFs, fixed income ETFs, whatever. You have to be consistent when you're buying. Always be consistent when you're buying, because there's a saying out there, not a saying, but there was a picture I saw. And it really hit home. And it was like, basically said, like, damn, I wish I invested 5 years ago. That's what you're going to be telling yourself in 5 years. Like, damn, I wish I invested, or I invested more. And I didn't want that to happen to me. I didn't want that feeling of kind of like, like, crap, I really should have put way more money into this portfolio. But it's scary, and I get it. It's dropping. It's always red. Are you investing in the right thing? Are you sure this is it? What if you're wrong? I got all that. I went through all those emotions, but I kept reading and rereading my notes and the research, and all the research pointed to that, hey, stay the course, keep going, be consistent, keep dollar cost averaging. And if you don't know what dollar cost averaging is you're going to keep buying whether it's low, whether it's high, or in between that. Right? If it takes a massive dip and you love the company, then why wouldn't you love the company at a cheaper price, right? So you dump more money into it. So that has been pretty much the rules that I lived by for these last 3 years. And I just kept staying consistent. I just kept buying these shares. And I know what you guys want to see. I know you guys want to see like the money, right? You guys, that's what you're here for. You're here to see that big number, right? But I tell you, this number doesn't mean anything. It's all the little lessons that you had to learn to get to that number, right? To be consistent, be disciplined, stay the course, stop listening to the news, stop listening to this person, that person, right? Do your own research, do your own due diligence. It's all those lessons that had to come to get to a number like this. So my advice to you guys, again, or a lesson I learned, was that you have to be consistent, all right? My third and final lesson that I was thinking about in the car ride. You can't be looking at this every single day, right? I know a lot of people want to, and it gets kind of you get those endorphins run or dopamine hits or whatever when you're seeing green and you're seeing your money start to rise and it's exciting and your net worth is growing. I know, I get it. It's exciting. It's sexy, to always see green. I get that. But really, you shouldn't even be looking at this every day. If you're an ETF investor, you shouldn't be looking at this every single day, right? Because when you're going to have these big dips, you are going to get emotional and you're going to be like, man, I should sell out. I should sell out. It's going to go down further. It's going to go down further. Like right now, just today, there's Donald Trump was mentioning that, Taiwan's going to have to pay money for U.S. protection. And that just instantly made the market, price that risk in if he becomes president and puts a price on Taiwan. And that just made a lot of technology companies, semiconductors, go down, right? Stock price just went down, right? But again, you shouldn't be checking stuff like that every single day, right? Because I guarantee you what just happened now with the technology in the semiconductor sector, I guarantee it's probably going to recover. Probably in a week or so. Maybe this week it'll probably recover. Maybe, I don't know. But along with that, every presidency, there's going to be something that happens to the stock market. Guarantee it. Every administration, there'll be something that happens, right? The stock market is volatile. It goes up and down, up and down, up and down. If you're a long-term investor though, and I know you are because that's why you're watching this, if you're a long-term investor, then you know that over long periods of time, that doesn't matter, right? Because as long as it's trending in the right direction, you're going up, then the daily moves up and down, it doesn't matter. That's why those big ups and downs didn't faze me. I mean, look at this. What if you bought some shares here, August 8th, 2023, and then it dropped? Look at that. It dropped so much. And again here, and I remember when this happened, I was struggling to I was looking under my couch for pennies at this point because I wanted to keep buying more. I wanted to buy more, but I just didn't have the cash, the liquidity for it. So again, don't look at the day to day. Don't look at the day to day. If you do, you're going to get emotional. If you see big dips, take advantage of them. If you love the company or the ETF at $100, then you're really going to love it at $90. And you're really going to love it even more at $85, right? If you know that ETF, if you've done your research, your due diligence, it has a track record, it's not a high risk play, it's not, some cover call ETF or, some high income, and I know a friend might be watching this, but some high income yield max, ETF where you're going to just be facing capital erosion all day. If you're buying ETFs or stocks, everything about them, that they have a track record of just consistent growth, then why wouldn't you buy more? All right. So those are my 3 lessons that I was just thinking about in the car. Ignore the news, ignore the doom and gloom. Don't believe everything you hear. Don't believe everything you see, and do your own research. All right. I'm very proud of the growth and the direction of this portfolio, and the dollar amount, while it's very sexy, it really isn't what excites me. What excites me is the prospect of this growing bigger and my thesis being true, right? My thesis, because that proves to me that I was right. When everyone was dogging on REITs and real estate, all throughout 22, all throughout 23, all the way up through 24, when everybody was dogging real estate and saying how bad they are, how crappy they are, it's terrible investment. Either I was mad at the time, and I know there's that famous Joker line from, the Batman, some will call you mad. I just say I'm ahead of the curve. Maybe that's that, right? But there's other analysts out there that are REIT analysts, REIT investors. And, those were the people I was listening to. Those were the people that were realistic. And they're saying it's going to be a bear market for a little while, so hold on to your pants. Don't expect some crazy gains over the next couple of years. Even my cell towers, they're not out of the water yet, right? they still have a ways to go. There's still a lot of headwinds, and headwinds is like pressure pushing the stock down, right? There are risks, that these REITs have. For cell towers, a lot of people are like, oh, satellites are coming. Satellites are going to be the internet. The new, you don't need cell towers. That's a whole load of hogwash. Only because try sending a technician to space to fix a satellite, right? There's always going to be cell towers. There always will be. And not only that, they're diversified too. American Tower has data centers. I didn't even know that. But yeah, American Tower has data centers as part of their portfolio. That's pretty neat. Crown Castle, one of probably the one that's been hit the most compared to the two. They had a fiber business. It's not panning out. They're really working on, or they're betting their money on their fiber and small cell towers, for cell phones for really high dense areas. That didn't really pan out. So they got rid of the CEO and they hired this new one. The new one is working on getting rid of that whole fiber segment, closing offices down, really trying to bring more value back to CCI, so again, I like it. There's still headwinds for them, but I trust what they are doing. I trust what the management, what the CEO, what the company is doing. I trust my money with them because ultimately that's what you're doing. You're trusting your money. I'll give it to industrials, but apartment REITs, multifamily, right? All these different REITs during the pandemic, they were so unfavorable. They were doing horrible. Investors were getting their money out of them because they knew that tenants weren't paying this and that, only to come to find out that all these REITs maintained at least, if not more, 92% occupancy across the board. All of them. That's wild. Even though we had this massive pandemic, a lot of people were not working, these guys were still getting their rents. So again, I knew that, during the pandemic, it wasn't going to last forever. Nothing really truly lasts forever, right? Eventually we were going to get through it. So I was trying to buy REITs as much as possible, especially apartments, because they were going down. And then as the economy opened up, as everything came back open, apartment REITs started to go crazy. And then, you guys know the rest of the story. Storage, simple business, boring business, nothing sexy about it. There's no new technology in storage, right? You're going to go put your box there, grab a key, lock the door and walk out, right? All you need is a concrete slab, 4 walls of sheet metal and, a couple rivets and a roof and boom, you're done, right? There's nothing sexy about it. You're renting space out to tenants. If they don't pay, you sell their stuff or kick it out to the curb, right? It's really easy, neat, simple business. But yes. These are the lessons I learned. All right. That's it. That's all I got for you guys. I don't want to take up all your time. I'm babbling too, but yeah, it's just these last couple of days have been awesome. Have just been absolutely awesome to be honest. To see that, the Fed is they're not saying it, but they're saying it, that an interest rate will come. Interest rate cut will come this year. It's going to drop rates, and there will probably be more in the future next year, and that's only going to put tailwinds, something to boost, REITs even more. I'm not saying go out and start buying REITs, like they're going out of style or anything like that. Again, just using my 3 lessons that I just went over, ignore the doom and gloom, stay consistent, right? And you always want to be dollar cost averaging, all right? You always be buying, right? Always be buying. So that's it, guys. All right, I'm going to shut up now. I've been talking too much. I'll see you guys in the next video. Peace.